In 2024, where do you see inflation going, and then where do you see interest rates? What's Cody's prediction for 2024?
Well, so we just had some new results, right? The CPI and the PPI just came out yesterday and today, and they're better than expected measures, so that's good. Things are heading the right direction. Inflation has proven to be very sticky, right? So people were getting government stimulus checks, they were getting raises, they were getting bonuses, because during COVID, a lot of industries were doing really well. Now that's subsided. There's some layoffs and people aren't doing quite as well there, but they have record credit and they have these new spending habits and they don't really want to give it up, right? And so now they're going into debt to maintain their lifestyle. That will come to an end, and I hope it doesn't come to a disastrous end for most people, but there will come a point in time where it's like, oh, well, you better tighten the reins because the credit card bill is getting too high. For some people, it will be, we're bankrupt, right? And that's not fun, and that I hope that doesn't happen for most of our friends and family, but it's going to happen for some people if they don't change their spending habits and they keep going into debt to maintain their lifestyle. Why I bring that up is inflation, right? If people keep spending money, inflation's going to remain sticky or possibly even go back up. So right now we're around 4% for that core number, and it's kind of been hanging out there for a few months. I do think the next 6 months is going to be bringing a significant reduction in inflation, mainly because of housing. The Fed and the government calls it shelter. Shelter is roof over your head, but it's also the cost of rent increases, and it's also short term too. Like you go rent an Airbnb. If those prices go up, shelter costs go up. If those prices come down, shelter costs come down. We measure shelter right now is a 12-month average, and we can see it, right? We've got the past numbers to know that there's this big bell curve in shelter. And so at the peak of that bell curve was like 15% year over year growth.
And we all felt it.
Yeah, for sure, right? Rental renewals 7-8 months ago were going up 10, 15, 20%. Now they're back to 3, right? Which is back to earth, right? So if shelter's going up at 3% per year right now, but we're taking a 12-month average, including that 15% number, right now the average is about 7.5. And so if we get a few more months at 3, then we're going to see that number come down to 3. The shelter component of the overall inflation is 43%. So when we see that number go from 7 down to 3 in the next 6 months, I think, then you're going to see inflation just jump down over the next 6 months, because it is the biggest piece right now. Food and energy and all these other things like durable goods, automobiles, they always add in, but shelter's the number one biggest component.
Shelter 12-month rolling average, it's showing, it's like cars on a train. As each month rolls through, the one at the end comes off, the new car comes on. So we can see shelters moving in the right direction. Then what does that mean for interest rates for our home buyers, our home sellers, and our investors?
Well, the reason why interest rates have climbed is because the Fed has one tool to fight inflation, and they smack that sledgehammer on us every time inflation gets high, and it's the Fed funds rate, right? Yep. So when they raise the Fed funds rate, that's what their tool for calming inflation. And when they raise the Fed funds rate, it basically influences the cost of borrowing everything. Generally speaking, we see a correlation between the 10-year treasury and the 30-year fixed rate mortgage, usually around 200 basis points. So if the 10-year treasury is at 2%, mortgages would be 2% higher than that, right? Yep. 4%, roughly. When the rates started spiking up, we saw a spectacular rise in interest rates. Loan officers like me, we make money when we originate loans, right? I help somebody buy a house, I get paid to do that. The mortgage company doesn't really make a lot of money on that transaction. They make money on the servicing, the continued collection of payments. Or if they don't do servicing, they make money on servicing and release premiums when they sell that mortgage to another company that's going to collect payments. They generally speaking make 0.25% per year. So it's not a lot of money, but times billions, it adds up. And so they typically factor that those loans are going to stay on the books for 4 years. 4 years times 25 basis points is 1%. So when mortgage companies saw these rates spike up, knowing full well that they will come back down, right? We don't know when, but they will come back down. They said these loans are not going to stay on our books for 4 years. We're not going to get our 1 basis point or our 1 percentage point, the profit that we want, that we normally get over 4 years. So we need it right now. And so they raised the margin. And every mortgage company across the board did this. And so right now we see that spread between the 10-year and the 30-year fixed rate mortgage at about 300 basis points versus 200 basis points. So I think that you're going to see inflation come down, you're going to see treasuries come down, mortgages will come down in tandem, and when mortgage companies see like, hey, this loan is going to stay on the books for a while.
For more than 4 years.
More than 4 years. Yes. They can then reduce that margin and say, okay, we can get our profit over the next 4 years instead of all right now. And some people say, well, gosh, if they are getting that margin now, why would they ever reduce it? Well, it's a free market. And there's competition. There's a ton of mortgage companies out there. They all did it because they all knew the same thing was going to happen. They're all going to pull back because they know the same thing is going to, right? Lender A, lender B, lender C, they're all going to come back to earth on that margin. So we're going to see kind of a double whammy good effect for clients and rates. We're going to see not only the 10-year treasury come down because of inflation, but we're going to see the 30-year fixed rate come down from that. And we're going to see that margin compression. And I think we could absolutely see rates probably 2% lower than where they're at today in the next 18 months.
Wow. So the lowering of inflation is the catalyst that then causes the treasury to go down. And as the treasury goes down, and we're talking the 5 or the 10-year, then the 30-year fixed debt goes down. And while that's happening, most likely due to competition, that's also going to cause that margin compression to happen.
That's right.
Smash the like button, hit subscribe. Thank you for watching. If you enjoyed this video, watch this one too.